Good morning, everyone, and thank you for joining me for today's webinar. This morning's session is all about the Sygnia Equity Fund. What I plan to take you through this morning is what you can expect as an investor into the Sygnia Equity Fund. I want to provide you with some insights into the portfolio construction approach that we follow, as well as give you insights into our manager research process. So how do we actually go about in selecting the asset managers that make it into the portfolio? We do have a new manager that we have included in the portfolio, so I will give you the reasons as to why we included them in the manager lineup. And then last but not least, we do have a new lower fee on offer. So let's get straight into it, starting with what you can expect as an investor into the Sygnia Equity Fund. This fund will give you exposure to South African equities. It aims to outperform its benchmark, which is the shareholder weighted index. So it aims to outperform the SWIX within a reasonable level of volatility relative to the benchmark. And it's a blend of active and passive. So it's managed on a multi-manager basis. And it's a low-cost product. Essentially, you would be buying into our best view blend of active and passive strategies. The portfolio construction approach that we follow is a core satellite approach, where you have the core of your portfolio being passive, and that really helps to give you that market exposure. It provides diversification, and of course, very importantly, this passive exposure helps to lower the cost of the overall portfolio. Then the satellites are a number of active managers. Now, the active managers have been selected in such a way that they complement one another, they blend very well with each other, and they're all bringing something different to the portfolio. When we analyze active managers, we see, many different managers with different styles. They follow different processes, different philosophies, and no single asset manager strategy is expected to outperform consistently through every market cycle. That is why it's a good idea to blend more than one active manager. So you blend a few of them together, and that provides additional diversification to the portfolio. It also lowers risk, so this diversification helps with the risk management of the overall portfolio. And then if you look at the portfolio collectively, this core satellite approach, this blend between active and passive, what this really helps with is that it provides you with a blended approach that can assist in outperforming the benchmark. So that's where the active managers come in, but then still being very mindful of costs. The way that we go about selecting the asset managers is quite a process, and we have a formalized process that we do follow. It's not to say that we simply look at, the performance, the historical performance of managers. Let's pick the 3 or 4 best ones and stick them into portfolio. It's not that at all. In fact, it's not only performance-based as well. There's a number of metrics that are under consideration. And I thought it would be a good idea this morning to take you through our manager research process, or give you at least some insights into the process that we follow. Starting off with the team. The investment team is led by 2 very smart gentlemen, Ian Anderson and Carl Hewlett, and they have a lot of experience in investment management. Our 2 heads of investments are backed by a very diverse, very qualified team of investment professionals that have diverse backgrounds, various qualifications, and collectively we have more than 130 years of combined investment experience. The way that we have organized ourselves from a manager research perspective is we have categorized the managers into different groups. And there are certain individuals or groups of teams that are responsible for each category of managers. And the level of research and the depth of research really depends on whether these are managers that we invest in, whether these are managers that are on a short list, or managers that we just like to stay on top of. It's always good to know what's happening in the investment industries, to stay up to date with any team changes, and to stay on top of the performance of the various managers, despite the fact that we may not invest with them. in any of our portfolios. So what you can see on this slide is the different individuals that are responsible for the different types of mandates. Within each one of these groups, we also split out the responsibilities per asset class. So somebody would be responsible for fixed income, a different team would be responsible for balanced mandates, for equity mandates. And this is how we have organized ourselves essentially from a manager research perspective. To give you the manager research process in a snapshot, I will talk you through this pyramid that sort of summarizes the way we go about our manager research process. In this specific instance, speaking specifically with regards to the manager research process for the Sygnia Equity Fund, our research led us to believe that a boutique manager would add value to the portfolio. Boutique managers, due to their size, they're more nimble, they can move in and out of positions relatively quickly. And our research led us to believe that this type of manager would really complement the other asset managers in the portfolios and would diversify the portfolio even further. So when you're starting the process of researching managers, you start with your manager universe. So if you look at the bottom here, we had the manager universe that was made up of about 126 different boutique managers that are available for us to invest in. At the bottom, I have included the size. Size can sometimes be a consideration. In this instance, as I mentioned, it was a consideration. We felt specifically that a boutique would blend nicely into this portfolio. So from a size perspective, you can split out asset managers into boutique managers, large, established, very well-known asset managers that have been around for many, many years. And then you also get a different category of asset managers, your more emerging managers. These managers have not been around for that many years. Their performance track records may not be as long, but nevertheless, for certain portfolios, these types of managers can add a lot of value. So in this instance, our manager universe was the boutique managers. Now, not every single boutique would manage every single mandate. So the mandate that you're after might not be available at some of the boutiques. In this specific instance, if you look on the right-hand side of the next sort of filter that we go to, we were after a specialist mandate, an equity, an SA equity only mandate. For other projects, we may be after balanced mandates. For certain clients, they may be after a certain BE level manager, so that is a consideration. And some of these are used as filters. So you filter from this 126 managers, you filter down to the ones that have your specific mandate. You can filter even further with regards to BE level, for example. I've included Sharia as an example. Some managers manage Sharia only mandates. That is a consideration in some of our Sharia type of portfolios. And then ESG can also be applied as a filter, but ESG is very, very important in our manager research process. And in fact, it's something that's considered at every stage of our process. Once you have then filtered down the managers to the ones that meet your requirements from a mandate perspective, we then start looking at the manager styles. So some managers follow a value style, others a growth, others would be a growth at a reasonable price type of style. Some managers call themselves contrarian, and others simply state that they don't follow a certain style. They're style agnostic, but they may be very good at trading in and out of certain positions, certain sectors, depending on the market environment. So that then filters down our list and it becomes smaller. And another important consideration is whether the individuals at these investment firms perform in-house research or broker research. So that's another consideration. We then filter down the list even further and we start with our analysis. And we perform quantitative analysis, that would be analysis on all the data, as well as a qualitative analysis. And the qualitative analysis involves meeting with as many team members as possible, meeting the individuals, the portfolio managers that are physically making the decisions for the portfolios, trying to get a gut feel for what they can bring to the portfolio, their passion for investments, try to understand their background, their history, their experience from an investment perspective. And the quantitative and the qualitative aspects, the analysis of both is equally important. It's not to say that we just look at data and based on data we make our decision. Meeting the individuals is equally important, and it's fully integrated into our process. Based on the meetings and the analysis of data, we then form a shortlist of certain asset managers that we would consider for inclusion into the portfolios. We then perform a due diligence, and then at the end, we make a decision on whether to buy, sell, or hold. Now, this manager research process is not something that we only undertake when we want to make changes in portfolios. We are constantly meeting with various active managers. So we have periodic manager reporting and presentations, and these presentations are not only with asset managers that we invest in, but with others that we have never invested in, with both global as well as local asset managers. It's really important to stay up to date with developments in the asset management industry. We often see key individuals move from one business to another, which is a key consideration when you're considering who you would like to manage the monies in your portfolios. We stay up to date with performance and any changes to their business structures. So the meetings do take place on a very, very regular basis. So how do we go about selecting these asset managers? So in that pyramid, I quickly showed you what the process looks like at a snapshot level. Very quickly, just how we go through the filtering process, but essentially we identify broad themes through time. As you can imagine, all of us that are working in the investment team, we're very passionate about investments. We work with investments 5 days a week and probably read about investments on the weekend. So we stay up to date with certain trends. And we identify these broad themes through time. So it could be boutique managers versus large managers. It could be an opinion from a sector perspective, resources versus financials, versus providing managers with the ability to manage global balanced mandates. It could be certain views or opinions on small caps versus large cap, or on the research, in-house research versus broker research. So once we have identified our theme, we then look for a range of managers that suit our themes. From there, some of the filtering takes place, as I showed you on that pyramid with our manager research process. So certain filtering will take place, and then we start the meetings. We have meetings with the key individuals, and we gain a lot of insight from those meetings. We typically meet with the CIOs, with the portfolio managers, with analysts, with the key decision makers as to what stock or instrument eventually makes it into the portfolios. They take us through their processes, their philosophies. They give us insights into their own process. In the same way that we have a process of selecting asset managers, they have their own processes of how they select stocks. They also start with the full universe of stocks, and they would filter them down, be it based on valuations, be it based on future earnings. So they will take us through the process. They follow into their stock selection. Once we have met with the managers, we will also request all of their data. And the kind of data that we request would be the returns analysis, going as far back as possible to inception of their portfolios, as well as their holdings. And we would analyze what kind of stocks they've been holding. We analyze their performance through various shocks or market cycles. And then we would discuss both the qualitative and quantitative aspects internally. So we'll have a discussion, we'll have this analysis, we'll consider both the quantitative and qualitative aspects, and then from there we'll get to a shortlist. Once a shortlist is generated, we dive in even deeper. This is where the operational due diligence takes place, the risk management due diligence takes place. We also try to meet as many of the team members as possible. At the end of the day, these are the teams that are making decisions in these portfolios. So it's important to meet as many of them as possible and try to, again, get a gut feel for the type of portfolio managers and analysts that there are. And then fee negotiations takes place. And the fee negotiations are really important, as the lower that we can get the asset management fees, the lower the fee that we can provide to you for the overall product that you invest in. The benefits of scale matter, and being a large multi-manager, we do have a lot of scale, and we are able to negotiate really competitive fees with these active managers, and ultimately resulting in lower fees for the overall product, as I mentioned. Then on the analysis side, the type of things that we calculate are risk and returns, scatter plots, and I'll show you some of the kind of data that we look at. We calculate various ratios. We look at a style analysis. So whether a manager has claimed to be a value manager or growth manager, some of them, as I mentioned, won't claim a style. They'll say that they're totally style agnostic. We have access to various external as well as in-house systems, whereby we can run their holdings, so all of the kind of companies that they owned and what they have held in their portfolios historically, and we can run those holdings through systems, and those systems will tell us whether a manager has been tilting towards a certain style or not. And for a manager that actually claims a style, if manager X told us that they're a value manager, and a value manager is a manager that looks for underpriced and unloved stocks in the market at the moment with, low valuations, we may look at the data, run it through our systems, and the data may actually suggest otherwise. So it's important to also hold managers accountable, to make sure that they don't just talk the talk, but they walk the walk, and we can check whether these managers are staying true to their styles. We then model these managers for suitability of inclusion into our existing portfolios. So a single asset manager, there can be various different circumstances that we face. Sometimes an asset manager on their own can do a phenomenal job, and you may not need the addition of another manager. In certain portfolios, you may have 2 active managers working together. In some instances, there could be 3, there could be 4, there could be 5. So you'll see different asset multi-managed portfolios can have a different number of managers. And the modeling of suitability for inclusion in current portfolios is a really, really important part of the process, because sometimes when you add a new manager, that can increase risk in the portfolio, it could reduce risk in the portfolio. You may find that by adding an extra manager, that the whole building block on its own may just start behaving like the index, because you have a little bit of everything. So there's various scenarios. We consider all of those scenarios, and we see whether the addition of this new manager makes sense, whether it adds value to the portfolio from a return as well as a risk perspective, and then we'll come to some sort of a proposal. And this proposal is then taken to the investment committee. So we have a formal investment committee that is chaired by our head of investments, and there's a representative from each asset class. So there's a specialist asset class person that is represented into the investment committee, and this is where we finally decide who the new manager will be. And this new manager may be just one, or it may be a blend of 2 managers that we want to include in a portfolio. Now, I want to show you some practical examples of some of the data that we actually have a look at. So once we have a short list, we summarize some of the key aspects of these managers. So we would look at things such as the assets under management that they have, their BE level, how long the company has been around for, how big is the investment team, are they well resourced, Can they cover, every single stock in every single sector? ESG, as I mentioned a little bit earlier on, very, very important. So do they do ESG screening? Do they have an ESG analyst? And then, of course, the style of the manager. So some, as I mentioned, may claim a style, some may not, and we have a summary of all of the managers. We then look at a lot of data. And the data is from a return perspective, so we'll analyze the returns of the managers, how they have performed relative to their own benchmark, how they have performed in various market cycles. We often have a look at the times in the markets where there were certain shocks. We'll maybe go back and look at how they performed in 2008 or the first quarter of 2020, when it was a very difficult time for a lot of active managers. So we look at their performance through the market cycle. And we don't only consider their performance on its own, but we also consider their blended performance. So their blended performance with asset managers that are already in the portfolio. So if we think about the Sygnia Equity Fund, we consider the blended performance of the new manager and how they perform together with the existing managers. So we look at individual as well as blended performance, and we analyze that performance going as far back as possible. We also analyze the risk in a lot of detail. So there's various risk stats that we look at, and looking at all of these numbers here, I will try to give you some practical examples. Looking at manager one, for example, there's various risk metrics that we have calculated. And on the downside, we can actually note that manager one is one of the riskiest managers out of this lineup. How we see this is, for example, they have the lowest average negative return at minus 3.3. They also have one of the highest average positive returns, meaning that you can expect this manager to do very well on the upside, but to also draw down quite a bit on the downside. So more of a manager whose performance swings to the upside and the downside. The maximum drawdown, which is the drawdown from the highest point to the lowest from a return perspective that they've had, is minus 30. Relative to the manager next to them, manager two, that manager's maximum drawdown was only minus 18.1%. Manager one also has the highest standard deviation. Standard deviation is a good measure of risk. It measures the dispersion of returns around the mean. So we can see that manager one had a much higher standard deviation than manager two, for example, at 12.8%. And then we can have a look at these risk stats for each manager as well as blending managers. So looking at blend one, for example, which is made up of manager one and two, what we can clearly see is by blending asset managers, you can expect a lower average negative return, so less negative. You can expect less of a drawdown. You can expect an overall lower risk as measured by standard deviation. So by blending a more aggressive type of manager with one that protects more on the downside, you can meet somewhere in the middle. And the split is not always 50-50. We play with various types of variations in the background. We'll try 60-40, 50-50. We have various ways to come up with the perfect mix of what will work best for the portfolio. So that's from a risk stats perspective. Then we'll also plot them on a risk and return scatter plot. So if you look at risk on the horizontal axis, the further right you look, the more risk the portfolio is taking on. So looking at manager one and manager five, for example, we can see that they take on more risk than the benchmark. The benchmark of these asset managers is the capped SWIX. So we include the capped SWIX on the risk return scatter plot, and we can clearly see that manager one and manager five have taken more risk than the benchmark, but they have also delivered a higher return if you look at the corresponding return on the vertical axis. Some other managers take on less risk but still provide a higher return, which is great from an investment perspective. And then we have a look at the blends, and we can see that by blending asset managers, you can reduce a lot of the risk in the portfolios but still enjoy the benefits of higher returns of the benchmark. So this is another very important aspect that we take into consideration when thinking about, which managers will work well with each other, which managers will blend well into the portfolio. Once we have made a decision and we start investing with an asset manager, the work doesn't stop there. We don't invest with them and then, hope for the best and forget about it. In fact, we perform very deep monthly coverage and analysis on all of our existing managers. Now, 91 has been an asset manager that has been on a lot of our portfolios for many, many years. So I'm showing you some data of the type of analysis that takes place on a monthly basis. And this is just a snapshot of some of the work that we do in order to analyze our existing managers. You'll note that the data is old. It's as at 31 December 2020. This is by design, as not to give away any of the current positioning of the managers. So the type of things that we analyze. If you look on the top left-hand side, we'll analyze their performance relative to the benchmark, and we'll see whether they have managed to provide some alpha, provide some outperformance through the various periods. Then if you look on the right-hand side, we also look at their positioning, and not just their positioning right now, but how they would have rotated their portfolio from the previous year, from the previous quarter. And we have a look at the rotation and the exposure that they have to certain sectors. So as you can see, we have the various sectors: basic materials, financials, healthcare, industrials, what the return of that sector was. And then this asset manager's weighting towards that sector as at the end of 2019, as well as at the end of 2020. And this is how we can see, for example, if they decided to sell out of a lot of financials and buy into industrials or any other sector. And we have a look at those weightings relative to the benchmark. At the bottom, we have the three broad super sectors. So that's your resources, industrials, and financials. And in this specific example, if we have a look at resources, for the 12 months ending December 2020, resources were the best performing relative to industrials and financials, giving us 21.1%. What did 91 have in terms of allocation to resources? As at the end of December, they had 31.9%. And as at the end of December 2020, a year later, they had 35.6%. So they increased their weighting to a sector that actually performed really well. So they made the right call from a portfolio rotation perspective. We also analyzed their top holdings. And when analyzing the top holding, this is where we have a look at whether there's an over-concentration to a single stock, which stock are we most exposed to. And when we do that across multi-managed portfolios, we can then see, where some of the concentration lies. So we have a look at what top 10 holdings they have and the weighting or the exposure, the percentage exposure that they have to that single stock. We also look at their top 10 overweight as well as underweight position. And we look at that relative to the benchmark and from a performance perspective, whether these overweight or underweight positions have added value from a performance perspective. And then we also have a look at their return as well as their rolling alpha. So how much alpha, how much outperformance they're providing us through each and every measurement period. In addition to having a look at the returns and the holdings, we also analyze our managers' trading activity, which is also a very important function. So we analyze daily holdings and we monitor them. So we identified the largest trading activity within the funds, and we also calculate the effect of that trading activity on the portfolios. So you can see on the slide for each one of the managers, we see what stocks they have added, what stocks they have deleted, and what the impact on the portfolio is. We do identify trends through time. We can see that managers may be selling out of a certain sector, trying to get into another sector. If anything is unclear to us, we immediately pick up the phone and we clarify these positions with the asset manager. Portfolio turnover is also really important. It's monitored. And if we find that there seems to be some type of unclear trading activity, then we'll also, again, get onto the phone immediately, contact the asset manager, and try to understand this trading activity. So a deep analysis and monitoring is performed after we actually invest with an asset manager. So now that I have taken you through our manager research process, I have given you a little bit of insight into how we go about selecting asset managers. Let's have a look at the Sygnia Equity Fund. The manager selection, so which managers have made it into the Sygnia Equity Fund, what the performance has been, and what you can expect if you invest into this portfolio from a positioning perspective. So as I mentioned earlier, we do follow this core satellite approach from a portfolio construction perspective. So at the core of your portfolio, you have the Sygnia Swix tracker. That is the passive portion. We have chosen to track the Swix and not the capped Swix for a number of reasons. And some of the main reasons are that the capped Swix has a higher turnover. And when you have a higher turnover in constituents, it also racks up transaction costs for the funds that are tracking that index. The capped Swix used to cap the NASPERS exposure to 10%. After the corporate action that took place in August, they were going to cap NASPERS and Process collectively at 10%. Then they said they would cap them at 6% each. So now in the capped Swix, Process is capped at 10%, NASPERS, at 6%, NASPERS is capped at 6%, and we wait a further announcement by December on whether the 6% will stay or whether it will be another percentage level. But due to these caps, it does create more turnover in the portfolio, and that does rack up transaction costs. So we find that the Swix is more suitable to track in this specific portfolio, and it does have lower transaction costs. Another good reason that we have chosen the Swix is the Swix has higher exposure to companies that generate a lot of their income from outside of South Africa. So you essentially have higher offshore exposure, which provides diversification in the portfolio. And then we have 4 active managers acting as the satellites to this core satellite approach to portfolio construction. And these are Coronation, 91 ABAX, and now the latest addition is Visio. So Coronation, 91 and ABAX have been in the portfolio for quite a while, and Visio is the latest addition that we have added to the portfolio. So essentially, looking at this mix, you are really buying into Sygnia's best view blend of active and passive. These managers are chosen for their differentiated views, for their different processes, their different philosophies, and their different approaches to portfolio managers. So they're all bringing something different to the portfolio. And they have been chosen in such a way to actually blend well together and to provide that diversification and to lower the overall risk of the portfolio. And as I mentioned earlier, by having this blended approach, you really have that opportunity to outperform, but staying very mindful of costs. Now, selecting asset managers is not that simple. As you saw in some of my slides, there's a lot of work that goes into the manager research process. It's not done simply on a performance basis. As I mentioned, the qualitative and some of the softer aspects are just as important as the data that we analyze. And if you've attended some of our webinars, I have no doubt that you would have seen some type of a chart such as this one. We call it our fruit salad chart of active managers. And this specific table summarizes the ranking and the performance of balanced managers from the Alexander Forbes Global Large Manager Watch survey. But the same situation is applicable to specialist equity-only mandates, or whether you're looking at fixed income managers, where you don't have one single asset manager that is at the top of the ranking tables consistently year on year through every market cycle. We can expect managers to do very well, then to do very badly. As you can see, we're not picking on Alan Gray here, but we've just chosen to show you, had you been invested with Alan Gray, you could be at the top of the ranking tables in 2008, then go right down to the bottom by 2010, then up again. So Managers do go through performance cycles, and that is why it's a good idea to leave it in the hands of the experts, leave it to us to do all of the hard work, and just simply buy into our best investment view. If you buy into the Sygnia Equity Fund, a year down the line, 3 years down the line, we may make a decision to remove a manager, swap them out for somebody else, and you know that at any point in time, you don't have to worry about the manager selection. We are on top of it. We are constantly monitoring the managers, and we will make changes to the asset manager lineup if we feel that the portfolio can benefit from a change in managers, from an exclusion, or from an addition of an additional active manager. So this new manager that we have added, Visio. To tell you a little bit about them, Visio is a level 1 BE contributor. They are led by their CEO, Patrice Royal, who is a very open and honest individual. He has been in the investment management industry for many, many years, and is truly passionate about what he does every single day. They have an extensive ESG scoring process. Now, I've mentioned ESG this morning a number of times, and it's become extremely important, not only from the effect that we have on the environment, from the effect that it has on communities from a social aspect, but it's an increasingly important process to follow from a risk management perspective. So asset managers that have an extensive ESG scoring process, you can expect them to have good risk management in place. And to give you some high-level practical examples, if you think about a company that may be facing a huge environmental disaster, it's probably not a good idea to invest in that company. Same goes from a governance. So, you know, the environmental is looking at the E. If you look at the G from a governance perspective, if through this extensive ESG scoring process, Visio finds that a company's governance is questionable, maybe their accounting is a little bit questionable, they would want to avoid another Steinhoff type of situation, and they would avoid that holding altogether. So focusing on the E, the S, and the G really does assist asset managers with risk management and identifying which stocks can pose a risk to their portfolios over the long term. They have a fairly large investment team size, so they're very well resourced. They have enough investment professionals, portfolio managers, and analysts to have full coverage of the various sectors and companies that are available for investment in their portfolios. And the company is growing, which is also great to see. It's a successful business that's growing, and just recently they've had 7 new hires. Every single staff member is a shareholder in the company, which is also important to consider. Every staff member is invests alongside the mandates that they manage, so that you know that your interests are aligned. They would also wish for the portfolios to perform well. As I mentioned, they would invest alongside their clients, and by having shares in the company, their interests are aligned in the sense that they also want to make, you know, the company better, for the company to do better, so they themselves can do better. So it's always great to see a good reward structure in place. And then when we analyzed their data, we found that Visio really did protect a lot in downturns. So when the economy is down, when markets are down, they tended to be less negative than the rest of the managers in the universe, the rest of the managers on our shortlist. So they had the lowest standard deviation, the lowest downside deviation, as well as the lowest average negative return. So you can really expect the addition of Visio into the portfolio. From the data analysis that we saw when looking at the historical data, we can expect the overall risk of the portfolio to be lowered. They also had the lowest correlation to the capped Twix and the highest active share, so the most different holdings to the other managers. What you also don't want when looking for an active manager is a manager that's really hugging the benchmark so tight And over the years, you may end up paying active managers fees for passive performance. So some managers don't tend to sway too far away from the benchmark, and they have a lot of their holdings that are very similar to the benchmark. Visio analysis of the data showed us that they are quite different, and also very different to the other managers on our shortlist. And then from a blending perspective, as I mentioned, blending is really important. We did a lot of modeling to see how the addition of Visio would add to the portfolio, and we found that it does add diversification and it does help with risk management. So we're very excited about this new addition and a fourth active manager now being part of the Sygnia Equity Fund. So looking at the 4 active managers, they are all different and they all bring something different to the portfolio. A quick little summary of each. Looking at 91, very well-resourced team, a company that has been around for many, many years, and they have offices outside of South Africa. The individuals in South Africa that are managing South African equities for the Sygnia Equity Fund, they have direct access to their colleagues offshore. So as much as they may be just managing South African equities, it's really important to have that global view, to understand different trends that may be happening outside of South Africa. We live in a very interlinked economy, so it's important to have that worldview view. So that's a huge benefit to a company like 91. From a philosophy perspective or a style perspective, they look to invest in companies where profits and earnings expectations are rising. So that is what they look for in stocks when they go through their stock selection process. Coronation, on the other hand, another very large manager, very well known. Their performance has been phenomenal over the last 5 years. They have a very established and strong team. They tend to have very high conviction views, and from a style perspective or from a philosophy perspective, they are after long-term valuation driven investment philosophy. That's really a good summary of how they think about or what they look for in stocks. They really focus on the valuations of their businesses. ABACs, bottom up, fundamental valuation driven investors. Their beliefs are that it's the earnings and dividend growth that are the primary drivers of share price appreciation. They also tend to invest selectively in cyclical opportunities as well as your faster growing, more emerging type of companies. So that's kind of the flair and flavor that they add to the portfolio. And then, of course, Visio, our latest addition. As I mentioned, they do offer great downside protection. So that reduces the risk of the portfolio. It is a boutique manager. So due to their size, they're able to get in and out of position a lot quicker than a very large manager would. So they're bringing that nimbleness to the portfolio. They also had very attractive fees, and of course, the very important ESG scoring process that they have in place, which really does assist them with risk management and being able to avoid certain companies that would pose a risk to the overall portfolio. So each one of these managers has been chosen for something unique, and they're all bringing something different to the portfolio. So let's have a look at the historical performance. From a ranking perspective, as of the 30th of September, this fund ranks 44th out of 77. Bear in mind that the universe is mostly actively managed South African General Unit Trusts, whereas a big portion of this portfolio is passively managed, and I will show you the split later on. So for mostly passive fund, it has done really, really well against its peers, and you can have a look at this cumulative performance since inception on the top right-hand side. The Sygnia Equity Fund is in the lighter blue line versus the SA General Equity category, and you can see nice outperformance of the Sygnia Equity Fund. And this performance also does not include the performance of Visio, as we have only just included Visio into the portfolio. From a sector allocation perspective, as at the end of September, The bulk is invested into industrials from a sector perspective, followed by financials and resources, with a very, very small allocation to cash. And looking at the split between the various active managers, 60% of the portfolio, so really the core of the portfolio is passive, and then you have your active managers acting as the satellites, and the 4 active managers have 10% each. That's your strategic asset allocation of the fund, and 60% is managed on a passive basis. And in this way, you have, the best blend between both active and passive at passive fees. We don't expect every single one of the managers in the portfolio to perform in the same fashion. In fact, we expect different performance from each one of them due to the differences in the style of their portfolio management. So we can see on a cumulative basis how each one of them have performed, so some better than others, and on a combined basis, the active managers in the portfolio really doing quite nicely from a performance perspective. The 1-year return, we can see the Sygnia Equity Fund at 24.8%. As you saw, the bulk of the portfolio is passive, and the addition of these active managers really give you the opportunity to outperform the benchmark. And that's exactly what this fund has achieved. So on the ranking table, relative to a lot of just fully blown active managers, further down the ranking table, but has this fund achieved what it sets out to believe? Yes, it has. The addition of a number of active managers have provided that opportunity for outperformance, and the fund has outperformed the SWIX over the 1 year. Over 3 years, looking even better, ahead of its own benchmark, the SWIX, bearing in mind it is mostly passive again. And over the 3-year basis, there's many, many active managers that this blend has managed to outperform. And a similar picture over a 5-year basis. Again, portfolio nicely ahead of a lot of other actively managed portfolios. And then very importantly, the fees. From a fee perspective, we can see that it's on the lower end. So the further down you look, the lower cost the portfolio is. The cost that we're showing you is the targeted to, so the total expense ratio. It's not just the management fee, but it's the management fee. Performance fees have been payable to some of the active managers that have done really nicely. So the total expense ratio at just over 1% as at 30 June. I didn't include September. The picture does not look too different, but at the time of preparing the presentation, only 32 out of 180 odd managers had submitted their 30 September total expense ratios. So that's the reason why this comparison is a few months older, but the picture is not too different as of 30 September. I just didn't want to show a list of managers when it's not the full universe. So we can see fees are on the lower end, and at the end of the day, the lower the fees, the higher the return that you can enjoy over the long term. And just to quote a study that was performed by National Treasury, their data showed that a regular saver who's able to reduce the charges on their retirement fund account from 2.5% of assets each year to 0.5% of assets each year would receive a benefit that is 60% greater at retirement over 40 years. So really showing you the power of low fees on a cumulative basis over the long term. And cutting your fees by 2% might sound like a lot, but if I may flip back to this slide, we can see that there's many, many asset managers that are charging more than 3%, closer to 4% total expense ratios. So it's very doable to be able to cut the fees of your investment portfolios by 2%. And then I'd like to end off with just a summary of why we believe the Sygnia Equity Fund really makes sense. You can now enjoy lower fees. So we have lowered the fees from 90 basis points. So this is the management fee. It used to be 90 basis points ex-VAT, and now we have almost half that. You can now access the Sygnia Equity Fund at a management fee of 50 basis points. you are getting our best view blend of active and passive at passive fees, essentially. And you can invest from as little as 500 Rand a month. Thank you very much for listening to me this morning. I'll see if there's any questions. Please do get in touch with me if there's anything that you think about after the webinar, and I'll be happy to answer any queries that you may have with regards to the Sygnia Equity Fund. Someone asked, why not add Alan Gray as an active manager? We have considered Alan Gray before for this specific project. As I mentioned, our research led us to believe that it's really a boutique manager that we needed in order to add value to the portfolio. Due to the nimbleness of the boutique asset managers, they are able to move in and out of positions very quickly. So to give you a practical example, if you consider a very large manager such as Coronations with billions of assets under management, huge portfolios that they manage, they cannot really get in and out of the smaller and mid-cap type of stocks. If they decide to allocate, even if it's just 1% of their portfolios to one of the smaller cap stocks, they would land up buying that whole company. Whereas smaller managers with a reasonable amount of assets under management can really be more nimble in the markets, really make quicker calls and move in and out of positions very, very quickly. Somebody's asking about the Divi Fund. Maybe I should flip back. It is definitely something to highlight. The Divi Fund, for those of you that may have missed the webinar, we held a webinar on the Divi Fund a few weeks ago. You can now access the Divi Fund at 0 management fee. So Class B is available at a 0 management fee, and this 0 management fee is forever. So you would only be paying the transaction fees, the trustee duties, all the other types of fees, and the actual management fee in Class B is 0. From a performance perspective, if I just flip back, we can see that our Divi Fund is at the top of the ranking tables over a 5-year basis. If you'd like to know more about the Divi Fund, we did host a 4-hour webinar unpacking the Divi Fund, why we believe it's a good idea to invest in the Divi Fund, specifically now in the current market environment. It is a value type of strategy, and value really does make sense when we're entering into an interest rate hiking environment. So please do have a look at our website. You can listen to the recording of the Divi Fund. And again, I welcome you to get in touch with me should you have any questions. So from a TER perspective, the Divi Fund, much lower TER due to the 0% management fee that is there forever. What percentage international exposure? This is a purely SA equity fund. So there may be indirect exposure to some of the companies that I mentioned. They are listed on the JSE, South African companies, but they may generate a lot of their income from outside of South Africa. But other than that, it is a local equity, SA equity only fund. I don't see any further questions, so thank you very much for taking the time to attend our webinar. The recording will be available on our website over the next couple of days. And if you have any questions, please do get in touch with us. Thank you very much.